Champ. Term book. Class 5th. Second term.
Mathematics. Chapter 4. Profit and loss. In business and finance, understanding whether you have made money or lost money on a transaction is fundamental. This is calculated by comparing what you paid for an item, cost price, to what you sold it for, selling price. 1. Cost price, CP. The cost price, CP, is the total amount of money paid to acquire a product or service. This includes the purchase price, transportation costs, and any other expenses incurred to make the product ready for sale. 2. Selling price, SP. The selling price, SP, is the final amount of money the customer pays to the seller to purchase the product. This is the revenue the seller generates. 3. Profit, gain. Profit is the financial gain achieved when the selling price is greater than the cost price. You have made money. 4. Loss. Loss is the financial detriment incurred when the selling price is less than the cost price. You have lost money. Overhead expenses refer to all the costs associated with running a business that are not directly tied to the production of a specific product. While direct costs, often called cost of goods sold, COGS, include things like raw materials and direct labor needed to create a product, e.g., a bicycle. Overhead represents the hidden or supporting costs that keep the company operating. Categories of overhead expenses. Overhead costs are typically divided into several key areas: administrative expenses, costs such as office supplies, accounting services, legal fees, software subscriptions, and executive salaries. Rent and utilities, ongoing payments for factory or office rent, electricity, heating, water, and internet services. Sales and marketing, investments in advertising campaigns, trade shows, marketing staff salaries, and website maintenance. Salaries and benefits, compensation for non-production staff, including payroll taxes, health insurance, training, and other employee benefits. The core logic is that profit adds value to the cost, while loss removes value from the cost. 1. Finding selling price, SP. If you know what you paid for an item and how much profit or loss you want to make, you calculate SP as follows. When there is a profit, you add the profit to your original cost formula. SP equals to CP plus profit. When there is a loss, you subtract the loss from your original cost because you are selling it for less than you paid. Formula: SP equals to CP minus loss. 2. Finding cost price, CP. If you know what you sold the item for and whether you made a profit or a loss, you can work backward to find what you originally paid. When there was a profit, the cost must have been lower than the selling price. Formula: CP equals to SP minus profit. When there was a loss, the cost must have been higher than the selling price, because you sold it at a deficit. Formula: CP equals to SP plus loss. Calculate the profit percentage or loss percentage. You are essentially determining what portion of your original investment, cost price, was gained or lost. The most important rule to remember is that these percentages are always calculated based on the cost price, CP, never the selling price. 1. Profit percentage. Use this when your selling price is higher than your cost price. This tells you how much profit you made for every $100 spent. Step by step. 1. Calculate your profit, SPCP2. Divide that profit by your original cost CP3. Multiply by 100 to convert the decimal into a percentage. 2. Loss percentage. Use this when your selling price is lower than your cost price. This tells you how much money you lost for every $100 spent. Step by step. 1. Calculate your loss, CP minus SP2. Divide that loss by your original cost CP3. Multiply by 100 to convert the decimal into a percentage.